By the end of this video, you'll have a basic understanding of what options are, learn some terminology, and I'll show you that options aren't really as scary as they might seem. Hi, my name's Josh, and if you're new to options, or a dividend or long-term investor looking for ways to multiply your wealth over time, then this video is for you. I understand that a lot of people think of day trading or Wall Street bets when they think of options, and it may seem like you're gambling or using a really risky trading strategy. The reality of options trading, though, is you can make it as risky or as safe as you want. Sure, with greater risk comes greater reward, but isn't that true with most things in life? The first thing we need to know about options is that they expire, and the closer you get to that expiration date, there are a few things that happen as you get closer. I'm talking about theta decay, delta, vega, etc., but that's more advanced and I'll get to that in another video. The next thing that you need to know about options is that they use leverage. This means that one option contract controls 100 shares of a stock. So if I own 100 shares of AT&T, I can leverage them to generate consistent income. This is important when we talk about strike prices and premiums because we need to multiply this number by 100 to get the actual value. So if you're using Robinhood and you haven't unlocked options yet, you can do so by going to accounts, down to settings, and then you can go down here to investing, down to the option level, and you can apply to change your level to 2 or 3 to have different levels of option trading. There are a few key elements to option trading that you need to understand before we can get into some examples of them. First, let's talk about expiration dates. You get to decide how long the contract is valid for. You can select expiration dates from 1 week out all the way to a few years out. And you can see that the further you go out in expiration, the higher the premium will be because volatility is already priced in. You also need to know that either the 100 shares or the capital used as collateral will be locked up for the duration of the contract, and this is more important the further you go out in time. On the other hand, if the underlying stock is a dividend-paying company, you'll still receive those dividends all the way through the contract. The next thing you need to know is about strike prices. The strike price is the amount that the buyer and seller agrees on, and this is really the amount that matters at the expiration date. There's no forum or anything where people get together to negotiate prices. It's literally as easy as entering your trade information and it automatically gets matched with someone on the other side. The next thing you need to know about is the premium, and on Robinhood it's called price. This is the amount that's paid by the buyer and collected by the seller to enter the contract. The seller gets to keep this premium no matter what happens with the contract, and they get it as soon as the option is entered. Let's say that somebody has this flask, which is currently priced at $48, and I want to have the right to buy it for $50 1 month from now. I chose $50 because I think that this flask will be worth $75 next month. Okay, so why would anybody want to enter a contract over this? Well, simple. I'm going to pay them $5 to do so. Let's look at an example on Robinhood. So if I wanted to sell a call option of AT&T, first I'd look at the current share price, which is $25.22. Next, I'd look over at the chance profit, and I'd see that $28 strike price right here is over the 85% threshold that I like to look at. Next, I would look over at the premium, and I would see that I'd get 21 cents per share, but if you times that by 100, that means I'll collect $21 to enter this trade. By the expiration day of March 18th, if the share price is at or above $28, then I'll have to sell that stock at $28. I still get to keep the $21 premium that I received, but if it was worth $29, I'd miss out on that extra 100. If at the expiration date the price did not reach the $28 strike price, then I would get to keep all 100 shares and the premium, and I'd be able to do this option all over again. The next thing you need to know is that options come in 2 basic categories, calls and puts, and you could either buy or sell each category. Buying a call option is a contract that gives the option buyer the right to buy an underlying asset at a specified price within a specific time period. The buyer here would have to pay a premium to enter this contract, and they hope that the stock price goes up before the expiration date. Buying a put option is a contract that gives the option buyer the right to sell an underlying asset at a specified price within a specific time period. The buyer here would have to pay a premium to enter this contract, and they hope that the stock price goes down before the expiration date. The benefit of buying options is that the profit is technically unlimited, and the maximum amount that you can lose is whatever you paid for in premium. It may not seem like much risk, but you can lose large amounts of money in a very short amount of time whenever the market is volatile. In another video, I'll cover how to trade options without needing all of the shares or the collateral to enter and exit the position. Selling a call option is a contract that obligates the option seller to sell an underlying asset at a specified price within a specific time period. The seller here would be paid a premium to enter this contract, and they hope that the stock price either trades sideways or goes down before the expiration date. Selling a put option is a contract that obligates the option seller to buy an underlying asset at a specified price within a specific time period. The seller here would be paid a premium to enter this contract, and they hope that the stock price either trades sideways or goes up before the expiration date. The only real risk when selling options is getting assigned when you're using a stock that you're not comfortable losing. You could also lose by selling options at a lower price than your average cost, which then becomes a realized loss if you end up getting assigned. The next thing that we need to understand is that options can be exercised by the buyer and assigned to the seller at any time before the expiration date. This basically means that the option buyer can cash out the option at any time throughout the contract or let it expire worthless. Also, if the share price is past the strike price on the expiration date, the option contract will automatically be exercised or assigned. For example, if I were to buy a call option of AT&T for $30 a share, and sometime throughout the contract, the price shot up to $45 a share, I could then exercise that contract, and the seller would be obligated to sell me those shares for $30 each. This would mean that I got those 100 shares at a $1,500 discount minus whatever I paid to enter the contract. On the other hand, let's say that the stock price stayed below $30 for the duration of the contract. It would be pointless for me to exercise it and pay $30 a share for something valued less, so I would just let the contract expire worthless. This would mean that me as the buyer would just lose whatever I paid to enter the contract, and the seller would keep their shares and that premium that I paid. In this case, if I wanted to buy 100 shares of AT&T for $30 a share, I would end up paying 79 cents per share, or a total of $79. Now, if I were to exercise this, it would cost me $3,079. So if the share price is not above $30.79 or the break-even point, then the option isn't really worth exercising, so I'd let it expire worthless. We talked about risk earlier, so now let's get into a little bit more of safer option strategies. Covered calls and cash secured puts. If you already own 100 shares of a stock and you want to make some money off of it, you can sell a covered call. To do this, you would ideally enter a strike price above the average cost per share, and then enter a date that you're okay with it being tied up for as collateral. The goal here is for the stock price not to reach your strike price by the expiration date so that you can keep your shares and then repeat the process. By entering a strike price above the average cost per share, even if you do end up getting assigned, you'll still make some money off of the trade. So this is important. If you don't want to lose a certain stock, don't sell covered calls at a strike price that doesn't have a high chance of profit. The general rule of thumb that I like to use is not selling covered calls at a chance of profit that's below 85%. Chance of profit is basically just an estimated percent that the share price will not reach that strike price, allowing you to keep both the 100 shares and the premium. If you don't mind losing the stock though, then there's no problem entering a trade at a lower chance of profit, and then you can even use that money to buy 100 shares of another company or for cash secured puts. A cash secured put could be thought of as like selling insurance. If you find a price that you don't believe the stock price will fall to by the expiration date, you could offer money as collateral to act as insurance in case the price does fall. And just like covered calls, if the contract expires worthless, you get to keep the money you put up as collateral and the premium you received. Another cool thing about selling puts is that you can use them to purchase shares at a lower price instead of just outright buying them at the current price. For example, if you want to own 100 shares of AT&T and it's currently valued at $25 per share, but you think that it's going to go down in the next few weeks, you can sell a cash secured put at a strike price of $22 a share, earn a little bit of premium, and then at the expiration date, if the stock price is at or below $22 a share, then you've just saved $300 instead of outright buying it earlier at $25 a share. The only way you lose here though is if the stock price significantly falls to something like $15 a share. Because you entered the $22 strike price, you would still be obligated to pay that for those 100 shares. But then you can use the wheel strategy and take those shares and start selling covered calls. If you have any questions about options, leave them down in the comments below. And if this video helped in any way or you learned something, give this video a thumbs up so YouTube will share this with more people. And then watch these videos next if you want to learn more about options trading or dividend investing.